So let's talk about the Nigerian Business and Markets Week. It's been a very busy week when everyone was talking about the state of the economy and the market in the new year. And yesterday, Chapel Hill Denham, one of the investment banks and securities trading firm, issued a very lengthy report about the fiscal landscape for 2020 and outlook on equities and currencies and fixed income. Putting all of that together, what you need to make a sense of. So Abimbola Omotola, who is the fiscal and the macro and fixed income analyst at Chapel Hill, is live here to talk to us about this report. He's joining us from the trading floor of the Nigerian Stock Exchange, the best place to be if you're talking about the market. Omotola, good morning, and it's good to have you on the show.
Good morning, Bossing.
Great. So let's talk about the background. We're doing an outlook. What you do is to provide a measure of what you call the macro background to your outlook. So what's the background to this report?
Thanks for the question, Bossing. So basically, our report tries to highlight the major macroeconomic vulnerabilities facing the economy, in 2020, and that ranges from both the external sector vulnerabilities to the political landscape, as well as the outlook for the financial market and for central bank monetary policy. And basically, for our report for 2020, what we did was to look at all these vulnerabilities in the economy, and we came to the conclusion that 2020 will be a very volatile year for the economy and the financial markets. But despite that, we are still very constructive on Nigeria as an investment destination. Firstly, we are expecting the GDP growth momentum to remain in a recovery mode and even accelerate further in 2020. With the growth expected to pick up marginally to 2.3% from 2.2% estimated for 2019, and that growth in 2020 will be mainly driven by the non-oil sector, and of course that outlook essentially is dependent on both demand side and the supply side variables. On the demand side, we are seeing increase in fiscal spending, fiscal expansion, both in terms of the current spending as a result of the higher minimum wage that was passed last year and being implemented this year. We're also seeing more spending by the government and the private sector on infrastructure and investments. So far, from 2018, we have seen investment spending in the economy grow by double digits as a result of both public investments in infrastructure as well as some large-scale private sector-driven projects. So that's very positive for the non-oil sector. From the supply side, we think that the oil economy will likely slow in 2020 as Nigeria is trying to comply with OPEC's production cost agreements, and also because of high base effects. But in general, we're expecting the non-oil economy to accelerate to 2.5%, in terms of growth for 2020 from 2% in 2019. So away from the GDP growth momentum, for the political landscape, we think we're actually witnessing a relatively stable political landscape, considering the fact that we just came off an election cycle in 2019, and the president as well has moved very swiftly to more or less, assure the public that it would not be seeking re-election, for the 2023 election. So we think that is very positive for the political landscape, and that is one of the major, as I would call it, one of the major sources of hope for the economy in terms of the political environment. And then for inflation, we're expecting price level to be under pressure in 2020, and that will be driven by some of the fiscal adjustment plans being proposed and already passed as well by the National Assembly. So firstly, we have seen the President sign the Finance Bill 2020, which is the major bill by the presidency to further improve Nigeria's revenue collection and also improve the ease of doing business environment. But the key highlight of the bill is that, number one, we are having a higher VAT rate going up to 7.5%, becoming effective from the first day of February 2020 from 5%. So that would be a major, upside risk for inflation over the near term. And then by April 2020 as well, the regulator of the electricity industry, the NERC, they have more or less guided, to the fact that there is a very high possibility that we'll be having, an upward review in the tariff for electricity. And going to the food basket, last year we saw the Federal Executive Council take a very decisive decision regarding Nigeria's, cross-border relationship with the rest of West Africa by shutting all the major, land borders, against trade. But of course, people are still allowed to move. But that decision, it has led to some upside risk on food prices and the broader headline inflation, to crystallizing. And we saw the food index being under pressure for much of the first quarter of 2020. And that would likely still be a major headwind for prices in the year. So we are expecting inflation rate to actually peak at around 13.2% year on year, coming from the year-end figure of 11.98% for December 2019. So away from the macros, for the financial markets,
yes, I was just about
of course, the central bank was
Omotola,
more or less
just a quick one, Omotola, before we go into the markets, try to make a sense of the title of this report from your firm, Chapel Hill Denham, on thin ice, riding the waves of uncertainties. So if all that you've, the background you've provided, a bit of what I call the wave of uncertainties, where is the thin ice here? Are we expecting the thin ice to solidify and get more solid, or do you think the wave of uncertainties will make the thin ice a little bit thinner and things could just crack through in the year 2020? What's it likely going to be?
Okay, thank you, Boasen. The title just simply depicts the fact that we believe that we are seeing mounting macroeconomic vulnerabilities, in the landscape, and some of the downside risks to macro stability. Some of them have a very good chance of crystallizing. From the external sector, we are seeing, current account deficits, widening to around 2.8% of GDP for the year, from 2.3% of GDP in 2019. So that's a downside risk, of course, to macro stability, and part of the reasons why we titled our outlook on thin highs. And away from the current accounts, on the capital leg of things as well, we are seeing portfolio inflows, slow down materially from what we had in 2019 as a result of, the fact that foreign portfolio investors are not fully confident yet of the bifurcated structure of the fixed income market. So that is a source of worry for them regarding the liquidity of the CBN's HOMO bills and the unsustainably low level, of fixed income yields. So that's a vulnerability for the economy as well. And of course, looking at the price level as well, we are seeing, inflation rates trending higher. And for the CBN as well, CBN is battling to contain the pressure on consumer prices. So there are lots of macro vulnerabilities, but we still believe that for the investment landscape in 2020, it still makes sense to be very constructive, bearing in mind that the CBN made some decisions last year that are boding well for the performance of riskier assets. So late last year, we saw the CBN actually decide to limit the participation of non-bank local investors, in HOMO securities, which essentially freed up about 3.7 trillion naira of liquidity to the financial system. And that liquidity has improved the risk appetite of the local investors, talking about both institutional investors and even retail investors. So we're now seeing more interest being generated, in riskier assets such as equities and corporate debt securities. We're also seeing more interest being generated in alternative asset classes, such as infrastructure, real estate, private equity, and credit. So all these things are also very positive for the economy over the near term. And we think that investors should continue to, while being wary of the vulnerabilities, should also, pay attention, to the opportunities that they can avail themselves, in the financial markets.
Okay, so we're going to talk about the markets now with your outlook from currency to fixed income and then the equity side. So we're going to hold on with you till after the break. But first, let's start about within the currency. What's your outlook for the currencies markets this year, in particular, our exchange rate regime and the direction of the naira?
Thank you, Boasen. So for the currency market, we think if we look at the naira from a fundamental perspective, the currency is already moving outside the range of fair value. So we like to look at the fundamental pricing of the currency based on the long-run real effective exchange rates, index. And we discovered that currently the currency in the official market, at least, is trading at about 1.1 percent standard deviation above the long-run mean. And so that implies that the fair value of the currency should be between 380 and 400 naira. But of course, as we know, for the outlook for the currency market, it is not just a case of looking at the fundamental analysis alone, but also looking at two critical things. Number one, the willingness of the central bank to defend the FX peg and their capacity to defend the peg. And currently, there is a will to continue to, defend the currency peg at around the currency de facto peg, to continue to defend that de facto peg at around 360 to 365 naira, as we can see. So late last year, we saw a bit of pressure in the currency markets coming from, increased capital outflows. But the CBN continued to intervene aggressively in the currency markets to ensure that we have stable exchange rates. And we don't think that will be lacking in 2020. We still believe that the CBN still, more or less, to a very large extent, believes that exchange rate forms a very critical part of the inflation outlook, and we continue to defend the peg.
Touching on the exchange rate regime in Nigeria as part of your outlook, your firm's outlook for the new year 2020, let's continue from there. Then we continue that into the fixed income space, which has a new paradigm shift that we're all trying to understand and get on the bandwagon on the new whatever highway that the financial regulator, the central bank, has designed now, and what that means for investors, both retail and institutional, in the new year. Please go ahead.
Okay, thank you, Boasen. So for the fixed income markets, I will start by looking at the primary market and then the secondary market outlook. So for the primary markets, we saw a record corporate debt securities issuance here in 2019, thanks largely to the central bank decision to limit participation of non-bank local investors in the HOMO market. So we saw corporate debt issuances, surging close to 650 billion naira from just about 590 billion naira last year. There's also the federal government of Nigeria increasing, their issuance of FGM bonds in the markets, rising close to 1.6 trillion naira, which is the second highest, issuance year on record. But for 2020, the key thing to note is that for the FGM bond market, we're expecting a relatively, smaller level of issuance. According to the DMO, the government plans to do about 1.35 trillion naira of FGM bond issuances in 2020. And that is largely because the federal government intends to continue to pursue its objective of rebalancing our debt mix in favor of more external debt. So towards that objective, the federal government is planning to do about $2.8 billion, of external borrowing to finance the budget, compared to zero that was raised externally for the budget in 2019. So the lower level of issuance by the federal government will potentially also continue to support the fixed income markets, in terms of yields. But for the corporate debt market, we're expecting increased level of issuances, by corporate firms. Particularly, we expect to see corporate issuers, looking more towards towards bonds rather than commercial papers to key into the low interest rate environment, to lengthen the maturity profile of their debt, and also reduce the refinancing risk that could come with issuing multiple commercial papers. So we expect to see lots of activities in the corporate debt markets in the year. And then speaking to the municipal market, so since 2017, we've had a very, very weak municipal primary market. 2018, we had zero issuance in that segment. In 2019, we saw, a very thin supply coming from Ondo State at less than 15 billion naira. But 2020 looks set to be a very, very good issuance year for the municipal segment. Already, the year started with a very large bond issuance by the Lagos State government, which raised 100 billion naira from the market. We are still expecting one or two issuances in the year, so that could potentially take us to the best, municipal issuance year since 2012. Then to the secondary markets, we think it should be a game of two halves. In the first half of the year, as we are currently witnessing, particularly the Q1 2020 and even early into Q2 2020, we expect the market to remain very well bid because of the fundamental demand and supply challenges in the market. So there is a lot of liquidity floating in the financial market today, and there is very thin supply, of investable assets, particularly fixed income assets, that investors can actually, take advantage of. So against that backdrop, we try to see the markets remaining well bid into Q1, when we have very large level of OMO maturities, and then we also have a bond maturity, coming in February, about 600 billion naira. But in the second half of the year, and even if I might say, early into Q2, we expect to see a marginal repricing, in fixed income yields.
Okay, so
and that repricing will be anchored on three major things.
Omotola, quick one. Is this repricing not already happening? Some folks believe that this repricing is already is beginning to happen right now. If you look at the secondary trading of both open market operations and NTB. Do you think it's already beginning to happen? We're looking at some NTBs here at around 8%. Yes. Please go ahead. Yes. Just looking at the numbers.
That's correct, Bossing. We are seeing a repricing in the treasury bills markets, but we haven't seen that filter into the bond market because of the fundamental issue of shortage of supply of FGM bonds that would likely occur into the second half of the year, largely because of the guidance by the DMO that the federal government will be looking to raise more funds externally. So the current repricing we are seeing is still mainly in the treasury bill scene. We haven't seen a similar thing occur in the bond market. But in the second half of the year, and even late into Q1 and early Q2 2020, we're expecting the repricing to take place both at the short and the long end of the curve. And as I was, discussing initially, that repricing will be anchored on three principal things. So the first thing is that Nigeria is in need of increased external financing to support the currency. So we are seeing current account deficits, widening to 2.8% of GDP in the year, primarily because the CBN is trying to push more lending to the private sector. And if you're trying to grow lending to the economy, that will lead to increased importation, of machineries, of raw materials, etc., further putting pressure on the current account. So there is a 2.8% of GDP deficit to fund in the current account. And there are three principal ways to fund that deficit. You could, take advantage of, foreign direct investments inflow, foreign portfolio inflows or external reserves. But Nigeria's foreign direct investment is very, very low, at just about 0.5% of GDP. So there's still a need for more portfolio inflows to fund the deficits in the current account. So that could potentially lead to the CBN trying to tighten liquidity, much later in the year. And if I can take you back to what occurred at the MPC meeting last week, where we had a very surprising hike in the cash reserve requirements. So that more or less signals that the CBN is also very wary of this liquidity. And as the year, moves on, they'll be, looking at alternative measures, not excluding CRR, to actually try to tighten that liquidity in the financial in the financial markets, to reduce the pressure on the current account. So that's one fundamental thing that could drive the pricing in the market. The second thing that could drive the pricing.
Omotola, quick one. I'm sure this is a whole lot that your firm puts together, and we can spend the whole day talking about it. But quick one, I want to touch with the asset, with the equities asset class here. You said your base case scenario is about 11%. Your outlook is suboptimal, but you said there'll still be at least a base case scenario of 11% index return this year. What will underpin this forecast from Chapel Hill? Just a minute. Thank you.
Okay, thank you, Boasen. So that expectation is driven, by both the liquidity glut in the money market that has encouraged, improved risk appetite by local investors. So positional fund managers who have very limited investable assets to put their excess cash, we think they will be looking to actually increase, their exposure to equities in the year. And we are seeing that, occur already. So since the CBN's policy was announced last year, we have seen increased inflows, by local fund managers, particularly the PFAs, into the equity market. So we think that's a potential catalyst for the market. Secondly, the outlook is also, essentially partly driven by our expectation, for the economy as well in terms of growth. So we're expecting growth to pick up, although very marginally, but the non-oil sector will be, a very major driver of growth, and the real sector. So that is also positive in a way for the equity market in 2020.
Omotola Abimbola, thank you so much. Macro and fixed income analyst at Chapel Hill, Denham. Thank you so much, and we'll get in touch in the days ahead as the year progresses. We're done with the first 30 days, or 31 days of January. By the way,